Now, you've probably seen the headlines: the Federal Reserve just cut interest rates. Hi, Matt Landon here. Now, you've probably seen the headlines: the Federal Reserve just cut interest rates. And this might feel like something that only matters to Wall Street, but the reality is there's very real implications they can have for you or for anyone near retirement. So let me walk you through a couple key ways that this can affect your income and some of the long-term planning that we're doing. Now, the first one has to do with bonds and interest rates. Now, when we talk about bond yields, when interest rates go down, new bonds and CDs are paying less. So this means if you're reinvesting, that income stream may be shrinking a little bit. So when we're talking about those CDs, a lot of times people will ladder CDs and you'll have it, and just as one comes due, you reinvest it. 3 months later, another one comes due, you reinvest it. Well, as those yields are dropping, that means those CDs are making less and less money. So if you're somebody that's counting on a 4 or 5% interest rate off of those CDs, you may see that shifting. So this might be the time to review your laddering strategy or explore alternatives that can provide some stability without taking on too much risk. Now, another one has to do with borrowing and refinancing. So borrowing gets cheaper. Lower rates reduce the costs on mortgages, reduce the costs on home equity loans, even business loans. This could also have an impact on car loans and things of that nature. For retirees and business owners, this could be an opportunity to refinance, free up some cash flows, or just deploy some capital in a more productive way. The thing you have to keep in mind here is this decision must be strategic. It's not just about pursuing lower payments. Now, the third way has to do with market valuations. So let's talk about the stock market for just one moment here. Rate cuts oftentimes give valuations a lift, especially in growth sectors. Think about it this way. If you're a business that's trying to grow and you're borrowing funds, if you're able to borrow those funds at a lower rate, it's less expensive, meaning you can either borrow more or you're going to free up a little bit more capital to use in other areas, which can give your valuation a lift. Now, this can also signal, though, that the Fed is worried about the economy slowing down, so they're trying to give it a little bit of a lift. So the real question then becomes, how much risk should your retirement portfolio carry right now? Balancing growth opportunities with income producing assets is going to be key moving forward. So that's something you want to evaluate and just keep an eye on from the risk standpoint. Now, what about inflation and real returns? So as rates are still falling, inflation has still been higher than the Fed's target, and this is eating into your purchasing power. So when you think about cash left sitting in the bank, it's losing value because things are getting more expensive. Now, your $30,000 is still $30,000, but think about inflation this way. 25 years ago, $30,000 went a lot further than it does today. We're feeling the effects of inflation right now. And so protecting against inflation, whether through its inflation-linked bonds, real assets, or more tax-efficient strategies, is going to be key. It's going to be really important moving forward. So finally, let's talk about estate and legacy planning. Now, this is an overlooked impact because lower discount rates make certain estate tools like GRATs, GRATs, or trusts more attractive. That means that right now might be a window of opportunity for families. Like if you're looking to more efficiently transfer wealth to the next generation, you might want to look at some of these different tools or revisit some of your estate planning tools and say, in this current market, is this still the most advantageous way to shift that wealth to the next generation? So in closing, a single rate cut touches more than just the interest on your savings accounts. And the reality is if we see a cascade or multiple rate cuts happening, it's going to have a more of an outsized impact than a single rate cut would. Now, the bottom line here is this. It's a good time for you to revisit your plan and make sure everything's aligned with today's environment, not last year's, especially considering that this environment is going to be continuing to shift. And so you really need to have a plan that's addressing those adjustments moving forward. Now, if you'd like to explore what this means for your family's retirement or estate strategies, I'd be glad to have that conversation with you. Hope you have a wonderful day. Thanks for listening.